Hey guys, welcome to this video. You will know if you follow me that I've done many posts on the pound New Zealand previously. Remember, if you want to get my free training, it's just under this video as well. I didn't do a stream this morning. I did one privately for my members. But if you look at my profile, like I said, I've called the pound New Zealand short so many times. All right, so I'm going to go from the start of the story and onwards. And I'm going to recap basically everything I said before and why. Because it's a really good chance to learn something about how markets work in general, and mostly I would say how to swing trade properly. So I'm going to use a horizontal line for this. I think they're up here. Yeah, there we are. If I draw a horizontal line here, and then I draw a horizontal line down there, what you can see clearly is sideways movement. In other words, the pound against the New Zealand dollar has said, I don't know if I want to go up, I don't know if I want to go down, so let's just sit somewhere in the middle for the time being. And what that does is it creates a really good trading lesson. It creates a really good opportunity for a trader to learn something about the markets. And I'll tell you exactly what that is now. So if you look to the upside to start with, you can see this candle here, and it comes right up and then it comes down. You can see clearly that what gets presented is a candle wick, isn't it? That candle wick here signifies that traders thought, you know what, at some point in the month, the market's gone way up. I want to kill off my positions because I've got a really good price here and I want to get out. Now, it's really interesting as well because when I was doing that this morning for myself, trading different assets, I thought, you know what, there's loads of people out there who are just pulling their orders out at the same time I am. And that's exactly what creates the candle wicks. This is the larger money in the market, professional traders, institutional traders. What the people who are making money will say, look, this price is high enough for me. And because it's high enough, it's a great time for me to liquidate my long side entries. Because obviously, if you want to make money, you need to exit longs at value, okay? And usually that's highs. In other words, you're getting a maximum price for your asset. If you went to the market tomorrow and you wanted to sell your car, you would ideally do it at the best price, wouldn't you? You would want the highest price, and so would loads of other people. And that's exactly what forms the market here. You've just got an amalgamation of the large money in the market who are saying, look, well, this price is very ideal. This price has come up so much, and I want to kill it off. So that's what caused that spike. And it's really important you understand that. That is what caused that spike. People saw the price, they thought, great, and it came down. So it's factual, therefore, to say that this is a value position. This is a place of value to exit long side trades. And of course, if you're exiting a long, remember, whenever you exit a long, you are effectively saying that you're short, okay? Because you're selling your position in the market, right? So if you're exiting a long, your bias naturally is short. And that's absolutely right at this point. So once you exit that long, you should be thinking, okay, well, now I'm out of the long. I don't think it's a buy anymore. Perhaps I should start to sell. So if you're doing that there, why would you not do it here when the market comes back to that price where all the larger money in the market is getting short? Why wouldn't you do that? And lots of people didn't. They bought there, which is obviously wrong. Fundamentally, that's just wrong. It doesn't make any sense. If you've just seen the price fall and people exit longs at value, why would you buy at the same point the next time? Doesn't make sense. So you will know, like I said, and I did this on all pound pairs, pound AUD, pound CAD, pound New Zealand, all of it. I said, look, short it. It's the end. Get out of your longs. If you took it long, great work. You did really well. But you should be trading like the people making money, and you should be liquidating those positions. And hopefully you did. Okay, hopefully you did, because it's been absolutely wasted. 216 to 205. Okay, I actually thought it was 214, but 216 is even further. Okay, so an absolute smashing, okay, absolute smashing straight to the downside. So the second part is, if you look down here, what can you see? Well, you can see the same thing, but on the flip side, you can see the markets actually were long at this point. So if this area up to the top is value for exiting longs, okay, this area at the bottom, conversely, must be value for exiting shorts, right? Okay, so the top side, you're looking to exit those longs because you've had enough of the move up and you know it's only a matter of time till it moves down, which is exactly what happened. And you're aware there are many people around the world sitting there who are making money saying, I'm going to short here and I'm going to exit my longs. And it's precisely what occurs, isn't it? It is precisely what occurs. You have to be trading in line with them. But back to the point, this top side is where people look short. So this downside has to be where people are looking long, doesn't it? Okay. So people must be looking long to the downside if they're looking short to the upside. So this is therefore enter longs at value. It's just the opposite of what you had before. When traders get to this point, they think exactly along those lines. Okay, they think, well, this is going to be long side value to exit. Now, they would also, like I said, if they're entering new longs at lows, okay, they would be selling their shorts at that point because, like I said, it's the opposite. If you're selling out your short position, you are saying that you think the market is going to rise. Effectively, that is just fact. All right. So if you've ever seen the price fall before, like now perhaps, and you're exiting that short, you're only doing it because you think the market could turn long. So that's exactly, again, what the larger money in the market, the professional people, are doing. Once you're coming back to those areas where you've previously seen the price bounce, then it becomes a long bias area. And you don't have to be a genius to sort of work that out, because you can see visually, you can see, look what happens at each point. Well, the price comes down and then it comes away, doesn't it? So you've got this continuum since 2017. I mean, you could even say it's as far back as, if I zoom out slightly, 2016. So you've got Brexit comes in, everyone's up in arms. 2016 to 23. So 7 years, you've more or less gone sideways with a little bit of deviation. But the fact remains, okay, this is where you've got your short side value because you're exiting those longs. This is where you've got long side value because you're exiting those shorts. And you can see both those things simply by looking at what has happened previously, looking for price action with candle wicks, understanding the economics of a market. I did a post on the economics of the S&P or global index markets, and it's all the same. It is actually all the same at the end of the day. You're just looking for when prices have come up so much and when prices come down so much, because in any market, if, for example, like you've had recently with the pound New Zealand, January to where we are now in September, that extreme move can't last forever. It can't go on forever. And obviously it doesn't, because we're now pulling down. People have had enough of it going up. January to September is 8 months. It's quite a long time. And if you look at the other moves comparably, August 19 to March 2020, okay, it's actually longer than some of these other rallies, quite a lot of them, and it's more forceful. So you've just got to understand that anything comes up really quick, it comes to levels of high market value for shorts, and then it comes back down to low market value for longs. And the overall trajectory of that can be seen on higher timeframes like your yearly, for example, and a lot of the support and resistance will get taken out. So if I swap to the yearly, you can see that. It's a little bit messy, but you can see there's hardly anything in the way between the low and the high, maybe a couple of areas of support, notably the one we're at now, where you can see we're falling to the level 205.3 area, and this candle wick here, this candle wick here, and that candle wick here have all got yearly support. So that's really fundamental, because we're now going to talk about how we can trade the market at the moment and why. So to start doing that, I'm going to begin on the monthly. Obviously, since we started September, it's now the 22nd. Okay, it's 3 weeks in. You've seen the drop. You've seen the drop from the high to the low, and you can tell at the top left, high 2.14143, low 2.05328. So the lowest we've actually gone so far, and actually today, is 2.05328. So where we're going from here is going to be a really, really good conversation. And I can tell you, I've just taken the market long today, not long ago, just before I shot this, and I said that to my members. Now, you'll remember that I just said, okay, well, if there's long side value down here, that's where you want to get long, and it's where you want to exit your shorts. Now, that is if you're an investor trader. In other words, you're willing to wait from January to September. Okay, I'm not. I would like to take more money in the meantime because I'm day trading. So if you're using a lower time frame than the yearly, i.e. the monthly, weekly, daily, you're looking for those quicker moves. If you're a scalp trader, obviously using hourly, 15-minute, 5-minute, 1 minute perhaps. But like I just said, what's really interesting here is if you look at your yearly, your 12 monthly, like we did a second ago, okay, and I'm just going to get rid of this for now, you can see what's happening is we're actually hitting onto some very key support. Now, you'll always hear me say, the higher the time frame, the more key the support. So you've got 3 instances where you've actually hit, where you've had rejection before. So that's obviously a very strong level, or it's likely or probable to be a very strong level long term. And I say probable because trading is all about probability and variance. Probability is how likely something is to occur, and variance is the range in which it occurs. Okay, so you can have a big swing in win and loss, or you can have a consistent profitability or probability. Okay, it varies. Obviously, if you've got lower probability, you're going to have a bigger swing. If you've got higher probability, you'll have a lower swing. In the market now, you can see the variance stretches from where we had it at back here at 2.176 all the way down to 1.81. That's your variance. It's a fairly reasonable cycle, but it's not enormous, because if you look back a bit, you can see it's actually much wider before. So it's a low variance market with higher probability, and that's why it's so predictable, like I said. But what's really key, like I said, is your 12 monthly support. But if you just look at your chart here, you can see this one disappears, but you've got this candle wick, that candle wick, and you've got this area here. So clearly, you've got really, really nice support, and that inherently puts the probability of your trade up. Now, you might, like I said, remember me saying, well, this is your long zone. But that is true for those waiting for much longer term trades. But you can exit and look for a bounce here, because it's likely in the near term that you'll get a bounce before you come all the way down here. Okay, this is just your ultimatum. But before then, you're going to have several bounces, because if you look before, I mean, what happens? That's a bounce, isn't it? There's a bounce there. It doesn't really come down in one straight line very often. So that gives you a lot of time to make money while the market falls. Okay? So I wouldn't be shocked currently in talking about the term right now if you get a bounce here, because you're at some really key monthly and some really key 12 monthly support. Yes, I think perhaps you'll get down here one day ultimately, but before then, I think this is going to occur. So that's why I've taken it long now, because I'm at such key levels of support. If it goes lower, and as many of you know, you've got all these moving averages here that are all lining up well. So, like I said, it wouldn't shock me if you get there. And I've been trading the spectrum of the pound New Zealand for ages now, up and down. But there's a lot of key support there as well, and likely some 12 monthly, but definitely some monthly support. And along with that, you've got a mixture of all these key moving averages. Also take note that your stochastic oscillator is still quite high up. Okay, so if you are buying here, you don't want to go nuts. You want to prepare for the fact that you could get lower, because you absolutely can. It doesn't matter what market you're trading, you can always get lower. So be very careful of that and make sure your risk is in line. But my overall bias is long on the pound New Zealand, and I'll be scaling in long further. But just understand, the higher you go, the more people liquidate their positions and get short, the smart money. And vice versa, if the price is low, they get long and they exit their shorts. Remember, exiting a short is the same as being long. Exiting a long is the same as being short. That is your bias. Thanks for watching, guys. Hope that helps. Get my free training underneath. It'll teach you a lot, and I'll see you in the next one. See you there.